Are you feeling overwhelmed by your student loans? Wondering how you're ever going to pay them back without drowning in debt? You're not alone. In fact, over 45 million borrowers in the U.S. alone owe more than $1.7 trillion in student loans. And let's not forget Canada and the UK, where students also face rising education costs and mounting repayment challenges. But here's the good news. You have options. And today, we're going to break them all down in plain language so you can make smart decisions and take control of your financial future. Welcome to the channel. If you're new here, we break down personal finance, insurance, loans, and money management in simple, relatable terms. So if that's something you care about, stick around. Let's dive into the real-world strategies that can help you repay your student loans without losing sleep at night. Let's start with federal student loans in the U.S., since they come with the widest variety of repayment options. The most basic plan is the Standard Repayment Plan. It's a 10-year fixed monthly payment. This is like the fast lane. It gets you out of debt quicker and with less interest. But the downside? Your monthly payments are higher compared to other plans. If you're earning a stable income and can afford it, this is the most cost-effective way to go. Next is the Graduated Repayment Plan. Payments start off low and increase every 2 years. It's designed for borrowers who expect their income to grow over time. Let's say you're a recent graduate just getting your foot in the door. This plan gives you breathing room early on and catches up as you earn more. Then we have the Extended Repayment Plan. This stretches your payments over 25 years, and you can choose fixed or graduated payments. It lowers your monthly burden, but you'll end up paying a lot more in interest over time. This might work for someone juggling multiple loans or supporting a family. Now, here's where it gets really interesting. Income-Driven Repayment Plans, or IDRs. These are the most flexible and forgiving options for many people. There are 4 main IDR plans: income-based repayment, income-contingent repayment, pay-as-you-earn, and revised pay-as-you-earn. Each one adjusts your monthly payment based on your income and family size, sometimes as low as $0 per month. For example, under pay-as-you-earn, you'll pay 10% of your discretionary income for 20 years. After that, any remaining balance is forgiven. Sounds great, right? Well, there's a catch. Any forgiven amount may be considered taxable income, depending on current laws. So it's not entirely free money, but it can be a huge help if your income is low relative to your debt. Let's take a real-world case. Sarah, a social worker earning $40,000 a year with $60,000 in federal student loans. On the standard plan, she'd pay about $600 per month. But under revised pay-as-you-earn, her payment could drop to around $200. And after 20 years of on-time payments, the rest would be forgiven. Now let's talk about Public Service Loan Forgiveness, or PSLF. This is the holy grail for borrowers working in government or non-profit jobs. If you work full-time in a qualifying role and make 120 qualifying payments under an income-driven plan, your remaining balance is forgiven tax-free. But here's the catch. The rules are strict and paperwork must be perfect. Many people have been denied forgiveness due to technicalities, like not consolidating the right loans or missing a certification. If you're considering PSLF, make sure to submit the employment certification form every year and stay on top of your loan servicer. Now shifting gears to Canada. In Canada, the Repayment Assistance Plan, or RAP, is the primary option for federal student loans. If your income is low, you can apply for RAP to either reduce or pause your payments. After 15 years, or 10 years if you're a person with a disability, your loan may be forgiven under certain conditions. Let's say Alex from Ontario earns under $30,000 a year. He could qualify for RAP and pay nothing at all for a period of time. And during RAP Stage 1, the government may even cover the interest on your loan. The key here is to apply every 6 months, because the plan doesn't renew automatically. And don't forget, each province might have its own loan and repayment options. For instance, British Columbia and Quebec manage their loans separately from the federal government. Now over to the UK. Things work a little differently there. UK student loans are income contingent by default. That means you don't pay anything until you earn above a certain threshold, which is currently around £27,000 per year for Plan 2 loans. You'll pay 9% of whatever you earn above that threshold. So if you earn £30,000, your annual repayment is just £270, about £22.50 per month. And here's something a lot of people don't realize. Any unpaid loan amount is automatically wiped out after 30 years. That's right. Whether you've paid it off or not, the slate is wiped clean. So for many graduates, student loan repayments feel more like a graduate tax than actual debt. Now, let's talk private loans. These are a whole different beast. Private loans don't come with federal protections like IDR or forgiveness. They're usually more rigid, with fixed or variable interest rates and limited flexibility. However, some lenders do offer forbearance or modified repayment plans in cases of hardship. So it never hurts to ask. If you're struggling with private loans, refinancing might be an option. You can potentially lower your interest rate or combine multiple loans into one. But be careful. If you refinance a federal loan into a private one, you lose all access to federal benefits. So, how do you choose the best repayment strategy? First, understand your loan type, federal, private, or both. Then look at your income, job stability, and long-term goals. Are you working in public service? Go for PSLF. Do you expect your income to grow? Graduated or extended plans might work. Are you struggling financially? An IDR plan, or Canada's RAP, can offer much-needed relief. And remember, staying proactive is key. Revisit your plan annually, update your income information, and keep records of every communication with your loan servicer. Student loans can feel like a heavy weight, but with the right strategy, you can carry it and eventually leave it behind. If you found this video helpful, do me a favor. Hit the like button, share it with someone who needs it, and drop a comment below telling us where you're watching from and what your biggest student loan question is. And if you want more videos on managing money, insurance, and financial freedom, don't forget to subscribe and turn on notifications. Thanks for watching. See you in the next one.